The 5 best credit cards by category. An institutional framework for strategic capital deployment. Before we start, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable advice. Now let's continue. If you're still choosing credit cards based on welcome bonuses and colorful marketing materials, you're leaving significant value on the table and potentially creating tax inefficiencies that compound over decades. This video deconstructs the institutional framework that wealth advisors use to architect credit portfolios for high-net-worth clients, revealing how strategic card selection intersects with liability management, tax optimization, and capital efficiency. By the end, you'll understand how to structure credit instruments to maximize float periods, optimize your cost basis for point redemptions, separate personal and business liabilities correctly, and build a credit architecture that actually enhances your balance sheet rather than cluttering it. Here's what makes this different from the countless card comparison videos saturating YouTube. Most financial advisors who specialize in credit optimization for business owners charge between $3,000 and $7,000 for the initial portfolio assessment I'm walking you through today. You'll want to take notes, because what I'm sharing is the same liability architecture framework that institutional planners use when structuring credit for clients with 7- and 8-figure annual expenses. And the mistakes I'll help you avoid are the same ones that typically cost entrepreneurs and executives tens of thousands in lost efficiency annually. Let's establish the foundational concept first. In sophisticated financial planning, credit cards aren't payment methods. They're short-term capital instruments with embedded option value. When we talk about credit as a capital instrument, we're recognizing that every dollar you put on a card represents capital that remains deployed elsewhere, earning returns for 20 to 55 days depending on your billing cycle and payment timing. For someone managing a business with healthy cash flow, this float period becomes a mechanism for maintaining higher average capital deployment in productive assets. A corporate executive with $200,000 in annual card spend isn't actually spending that money daily. They're accessing a revolving credit line that effectively gives them an additional $18,000 to $30,000 of working capital on average, depending on their payment cadence and cycle optimization. The strategic implication here is profound. Your card portfolio should be architected around maximizing this float, while simultaneously extracting maximum value from reward structures that align with your actual capital deployment patterns. Most people do this backwards. They chase rewards categories that don't match their organic spending, which introduces inefficiency and often leads to suboptimal utilization patterns. Now let's address entity structuring and what I call liability separation architecture. If you're operating any business entity, whether that's an S corporation, LLC, or partnership, keeping personal and business expenses on the same card isn't just sloppy bookkeeping. It's creating substantiation risk that the IRS specifically targets during audits. The doctrine here is simple. Business expenses should flow through business credit instruments held in the entity's name, with the entity making payments from business accounts. This creates a clean audit trail and ensures that you're not commingling funds, which can pierce corporate veils and expose personal assets to business liabilities. Here's where most entrepreneurs create problems. They open business cards in their personal names with personal liability, then run business expenses through them, creating a hybrid structure that satisfies neither tax efficiency nor liability protection goals. The correct architecture uses true corporate cards where the business entity is the borrower. Yes, this sometimes means providing personal guarantees during the application phase, but the legal structure differs meaningfully. When your LLC is the account holder, expenses run through the LLC, and the LLC makes payments from its operating account. You've created proper separation that withstands scrutiny. This connects directly to tax timing strategies that most credit card content completely ignores. Under current IRS rules, business expenses are generally deductible when charged, not when paid. This is the accrual method versus cash method distinction, and it matters enormously for businesses above certain revenue thresholds. If you charge a significant business expense in December, but don't pay the credit card bill until January, you've created a timing benefit. The deduction hits the current tax year, while the cash outflow occurs in the following year. For businesses managing quarterly estimated tax payments, this timing arbitrage can improve cash flow positioning significantly. Let's get technical about credit utilization mechanics, because this is where sophisticated users separate from casual card holders. Your credit utilization ratio, the percentage of available credit you're using, affects not just your credit score, but your future borrowing capacity for mortgages, business lines of credit, and other capital instruments. Most guidance suggests keeping utilization below 30%, but institutional planners target below 10% for clients preparing for major financing events. Here's the framework. If you're planning to secure a commercial mortgage or significant business credit line within 12 to 18 months, your card utilization strategy needs to shift 6 months before application. This means either increasing credit limits across existing cards, paying balances multiple times per billing cycle to keep reported utilization low, or temporarily reducing card spend in favor of direct bank payments. The credit bureaus typically report your statement balance, not your current balance, so strategic payment timing before statement close dates becomes critical. The cash flow amplification concept works like this. By concentrating all eligible business expenses on cards with 55-day float periods, achieved by making purchases immediately after statement close, you're effectively creating an interest-free working capital line. For a business spending $20,000 monthly on eligible card expenses, optimizing payment timing can keep an additional $20,000 to $30,000 deployed in the business at any given time. That capital might be earning returns in short-term treasuries, funding inventory purchases at optimal times, or simply providing liquidity buffer that reduces the need for expensive credit line draws. Now we get to reward structures, but framed correctly. Rewards are basis reduction mechanisms, not free money. When you earn 2% cash back on a business expense, you're reducing the cost basis of that expenditure. For tax purposes, the IRS generally treats credit card rewards as rebates rather than income, meaning they reduce the deductible expense rather than creating taxable income. A $10,000 marketing expense that earns $200 in cash back becomes a $9,800 deduction. This is basis reduction, and it's how institutional planners think about rewards. The strategic question becomes, which basis reduction mechanism aligns with your actual capital deployment? If you're spending heavily on advertising, and many business owners are, a card offering high returns on ad spend reduces that cost basis most efficiently. If you're traveling frequently for business, cards offering enhanced travel redemption values provide superior basis reduction on those specific expenditures. For travel rewards specifically, understanding transfer partner arbitrage separates sophisticated users from point chasers. Transferable point currencies, the kind that move to multiple airline and hotel programs, contain embedded option value. When you hold 100,000 transferable points, you're not holding a fixed value asset. You're holding optionality that can be optimized based on future redemption opportunities. Historically, these points have generated redemption values ranging from 1 cent to over 5 cents per point, depending on program and usage. That variability is exactly what creates the arbitrage opportunity. Here's the liability architecture framework for business owners. You need at minimum 2 distinct credit profiles, personal and business. Your personal profile handles all non-deductible expenses and should optimize for rewards categories matching your lifestyle spending. Your business profile handles all deductible expenses and should optimize for rewards matching your business spending patterns. These 2 profiles should never intersect. If you operate multiple entities, each entity should maintain its own credit profile to preserve liability separation. For executives and business owners dealing with international transactions, foreign transaction fees represent a direct cost that reduces capital efficiency. A 3% foreign transaction fee on $50,000 in annual international spend costs $1,500. That's a direct hit to your cost basis with zero value received. Cards with no foreign transaction fees become mandatory tools for international business activity, and the analysis should factor in currency conversion timing as well. In some cases, charging in local currency versus USD can create meaningful differences based on conversion rate timing and merchant processing approaches. Let's address annual fees through proper cost of capital analysis. A card with a $695 annual fee isn't expensive if it's reducing your cost basis by $5,000 annually through superior rewards rates on your actual spending patterns. The math is straightforward. Calculate your expected annual spend by category, multiply by the incremental rewards rate advantage over no-fee alternatives, and compare to the annual fee. If the incremental value exceeds the fee by a comfortable margin, typically I suggest at least 50% margin to account for variability and opportunity cost. The fee is justified. Returning to utilization ratios with more nuance. Banks don't just look at your credit score when underwriting significant loans. They examine your total available credit, current utilization, and payment patterns. High credit card limits with low utilization signal strong credit management and provide reassurance about your liquidity. Conversely, maxed out cards, even if paid on time, signal potential cash flow stress. For anyone contemplating major financing, commercial real estate, business acquisition, significant mortgage, your credit card utilization 6 to 12 months before application becomes part of your financing preparation strategy. From a risk mitigation perspective, credit cards provide fraud protection that direct bank payments don't. When business expenses run through cards, you've created a layer of separation between vendors and your operating capital. Fraudulent charges can be disputed without impacting your actual bank balance, and the dispute resolution framework heavily favors cardholders. This liability limitation has real value, particularly for businesses dealing with new vendors or online transactions where fraud risk is elevated. The interplay between card float and cash reserves deserves attention. Many businesses maintain larger cash reserves than necessary because they're not optimizing payment timing through credit instruments. If you can safely predict that $20,000 to $30,000 of monthly expenses will run through cards with 45 to 55-day float periods, you can reduce idle cash reserves by a corresponding amount and deploy that capital more productively. This is cash reserve optimization through credit architecture, using the float period as a structural component of your liquidity management rather than treating cards as simple payment tools. Here's a tactical implementation of strategic timing. Request statement close dates that align with your cash flow cycles. If your business receives major client payments around the 15th of each month, having card statements close around the 20th gives you maximum float. You make purchases immediately after the 20th. Don't see them on a statement until the following month, and have another 25 days after that before payment is due. That's 55 days of float on purchases made on the 21st. This statement close optimization is a free efficiency gain that most people never implement because they don't understand the mechanics. Let's get specific about point valuation methodology, because this is where marketing hyperbole clouds institutional analysis. Credit card companies and affiliate marketers often claim points are worth 2 or 3 cents each based on theoretical best-case redemptions. Institutional analysis uses conservative, achievable valuations. Cashback at 1 cent per point, transferable points at 1.5 cents per point assuming competent, but not obsessive optimization, and fixed value travel points at their stated redemption rate. Using conservative valuations prevents the common mistake of overvaluing points and making spending decisions that don't actually generate positive returns. The complete liability architecture for a business owner should look like this. One primary business card for general business expenses, potentially a second business card for specific high-spend categories if the reward structure justifies it. One primary personal card for personal expenses with rewards matching your lifestyle spending, and potentially a no foreign transaction fee card for international activity. That's 3 to 4 cards total, each serving a specific structural purpose within your overall credit and liability framework. More cards than this typically introduces complexity without commensurate value, unless you're operating multiple distinct business entities. Understanding tax reporting mechanics helps avoid common errors. Business card rewards earned on business spending are treated as rebates that reduce expense deductions. This happens automatically through your accounting if structured correctly. Personal card rewards on personal spending are generally not taxable. Where people create problems is using business cards for personal expenses or personal cards for business expenses, which muddles the tax treatment and creates substantiation issues during audits. The clean architecture I described earlier eliminates these problems entirely. Your credit limit expansion strategy should be proactive, not reactive. Request credit limit increases every 6 to 12 months on cards you use regularly and pay on time. These increases rarely trigger hard credit inquiries if you're an existing customer in good standing, and they improve your utilization ratio even if your spending doesn't change. Higher total available credit with the same spending level means lower utilization percentage, which benefits your credit profile. This is free optimization that requires minimal effort but compounds over years. The final piece is integration with your banking structure. Your card payment strategy should align with your overall treasury management. For business cards, payments should come from business operating accounts to maintain clean separation. For personal cards, payments from personal accounts. If you're using automated payments, set them for a few days after statement close rather than the due date. This ensures you're reviewing charges before payment posts, catching any errors or fraudulent transactions early. Before we end, let me summarize these critical insights that separate institutional credit management from casual card usage. First, view credit cards as capital instruments providing float value, not just payment methods. This reframes how you think about every dollar you charge. Second, maintain strict liability separation between personal and business credit profiles to protect both tax efficiency and legal liability protection. Third, optimize credit utilization ratios as part of your borrowing capacity strategy, keeping utilization low particularly before major financing events. Fourth, use conservative point valuations to make rational decisions about rewards optimization versus actual spending patterns. Fifth, implement statement close timing and payment timing strategies to maximize float periods and maintain ideal utilization reporting. Sixth, integrate your credit architecture with entity structuring, tax timing, and overall treasury management for systematic capital efficiency. Here's the verdict. The best credit card portfolio isn't about finding the single highest rewards rate. It's about architecting a complete liability and rewards structure that maximizes capital efficiency, maintains proper entity separation, optimizes tax timing, and aligns rewards with your actual spending patterns. For most business owners and executives, this means 3 to 4 carefully selected cards, each serving a specific strategic purpose, with spending concentrated on the cards offering the highest marginal value for your specific expense categories. The annual value of getting this structure right typically ranges from $5,000 to $20,000 for someone with substantial business and personal expenses, making this one of the highest return activities in personal financial management when measured against time invested. The implementation timeline matters. If you're currently using a haphazard card structure, fixing this doesn't require closing accounts or disrupting your credit history. Start by opening the proper business cards in your entity's name, shifting business expenses to those cards over 30 to 60 days, then optimizing your personal card structure separately. The transition can be gradual while maintaining the credit history benefits of your existing accounts. Subscribe for institutional-grade financial analysis that treats you like the sophisticated decision-maker you are. Like this video if it changed how you think about credit architecture. Comment with questions about your specific situation. I read every comment and often address common questions in future videos. Disclaimer: I am not your financial advisor. This content is for educational purposes only. Consult with qualified professionals before making financial decisions.